Hi everyone. In this lecture video, I will go over the topic of capital budgeting. So capital budgeting is just applying the net present value methodology that we learned in the previous lecture video to making financial decisions from the corporation's perspective. So what I'm going to do is I'm going to first define what cash flow looks like from the perspective of firms, and this is typically called capital budgeting. Next, I will talk about other ways to make financial decisions that's typically used in this finance industry, such as using the interest rate of return, or IRR. This is actually related to bond valuation, and you'll see the parallels between IRR and bond valuation when we get to the third lecture video. Fourth, I will talk about what a profitability index is. This basically looks like a ROI, or return on investments, but you should basically draw the same conclusions using this index as if you use the MPV method. And lastly, I'll talk about the last method of making financial decisions called using a payback period. So that's basically just calculating how soon you can recover your initial investments once you decide on investing in a particular project. Okay, so of course, different objectives. The last one, for example, we're talking about finding the earliest date in which you can recover your initial investments. That's very different than what you would get from, for example, the MPV method. And I'll talk about the differences between these two methods conceptually. Okay. All right, so just to review what we learned so far. So in this class, we have so far introduced how to map present value to future value. And we do this through interest rates. And as I mentioned in the first video, interest rates, you should think of it as simply opportunity cost of pursuing a particular, making a particular decision. Whether if it's to consume or to buy something today, your opportunity cost of buying that object would be to put it in the bank and earn some sort of interest on it. Alternatively, you can think of interest rates as the interest that you require such that you would part with your money today. Okay, both are saying the same thing. It's some form of foregoing a decision today so that you can accumulate resources in the future. Okay, so let me emphasize that we map present value to future value through the use of interest rates, which is our way to proxy opportunity cost or return, or it's another way of saying returns of the next best alternative investment. Okay, so I know this is very conceptual as of now. It's not very concrete. Once we get to bond valuation and equity valuation, it'll be clear what interest rates actually represent. This is actually where our source of risk is going to come through in our model. All right. Second, we also talked about interest rate convergence. That means we're converting one compounding interest rate to another compounding interest rate. As you saw in the previous lecture, that's quite simple once you get the formula down. And I also introduced to you some growth models, specifically annuities and perpetuities and variations of those two, whether or not you delay a particular annuity or perpetuity, and whether or not you incorporate some growth rate to the cash flow, right? And lastly, I introduced to you the concept of net present value. It's basically taking the present value of costs and benefits and adding them together, right? And remember, MPV is separable, meaning that we can combine costs and benefits together and calculate the present value, and that will give us the same thing as calculating the present value of benefits itself, subtracting the present value of costs, right? So let me show you what I mean. We can alternatively just think of it as taking the present value of benefits minus costs, right? Rather than computing the present value separately. Okay, so as I mentioned earlier in the previous lecture, MPV is useful because it allows us to make financial decisions because we can compare costs and benefits that have different cash flow payments in the future today. Okay, and so this is a decision-making tool. And the rule in general, which is I think quite obvious for using this MPV, is to just choose the highest possible MPV project, right? Of course, given your resources. So if you have X amount of dollars and you can only spend the X dollars on certain projects, you would only choose the one with the highest MPV. If you have several projects and you have a large budget, then you would just go down the ranks. You would choose the highest first and then the second highest and so forth. So the decision making is quite straightforward or very linear. All right. So let's talk about the fundamentals of capital budgeting. So let's talk about the motivation of why a firm might go about using MPV rule to make decisions. Okay, so what are some goals that firms have to achieve? So let me just list some goals that firms might have to think about. First, they might want to think about mitigating risk. I think about the example that I gave you in the previous lecture. If a certain firm doesn't want to be exposed to certain type of risk, they have to find some way to insure against that risk. And they may have to buy a certain contract. Buying that particular contract means you may have to pay a sequence of fixed cash flow payments for that protection. And you would have to evaluate or put a value on that contract and make sure you're not getting ripped off, right? So mitigating risk is an important goal that a firm should think about. Secondly, the most obvious objective for firms is probably maximizing profits. Okay, so of course this is a complicated question. Firms may not always want to maximize profits and every time horizon, right? They may sacrifice short-term losses. They might sacrifice short-term profits for long-term profits. Okay, so it really depends on how you model the cash flow payments of certain projects and calculates MPV, and make sure you choose the one with the highest MPV value. So an example would be perhaps a firm wants to invest a certain period to establish market power, right? Something like what Amazon basically has done for the past several years. They are trying to basically sacrifice short-term profits, but overall in the long run, they establish a monopoly over many consumer products, and therefore they have, at the end of the day, monopoly pricing power, and therefore profits will be exorbitant. Okay, so that's just an example of sacrificing short-term versus long-term, for example. And at the end of the day, it depends on financial analysts at these companies to figure out if the present value of pursuing such a strategy outweighs the short-run sacrifices. Third is, for example, a firm may want to think about growing a brand, right? That requires a lot of short-term investments such as marketing and establishing a presence through different platforms such as Facebook, YouTube, whatever. It requires, in other words, investments. And realizing its returns, you need to, of course, project those returns in the long run, and then eventually calculate the MPV and compare different strategies by comparing MPV values. And lastly, growing the firm, right? Which is related to profits, right? And growing the firm can take in many dimensions, and it really depends on how you think about it in terms of, for example, hiring workers. If you want to grow the firm in terms of increasing, human capital, then of course you would need to think about the value that's contributed by these, the skilled workers that you plan on hiring, or the talented managers that you plan on hiring. Anyways, at the end of the day, you need to think about the net present value of all these decisions, and you make sure you choose the one with the highest one, given your constraints. All right. And so to summarize, the ultimate goal of a firm These are just examples, but if you want to take a step back and what all of these objectives look like, on balance, what the firm is trying to do is it is trying to maximize the value for its owners, right? Who are the owners? They are, creditors / debt holders. That's the same. They're the same people. In other words, they're people who give the firm loans. In other words, they are stakeholders of the firm. They want the firm to survive because if the firm fails, they would fail to recover their initial loans, right? So creditors, bondholders, they all have stakes within the firm. And then the more obvious stakeholders are stockholders or shareholders, right? They're the ones that are, in order to become a shareholder, you buy their stock on the secondary equity markets. And if you hold on to it, you're basically betting that the value of the firm grows over time or it pays dividends sometime in the future, right? These are different stakeholders, but overall they are stakeholders of the firm, in addition to creditors and bondholders. All right. So this maximizing value for the owners is the same thing as what we're claiming here is maximizing the NPV value of all future cash flows. Okay, so this is what we're trying to model. We're trying to model the cash flows of every single decision that might occur at the firm, and we're claiming that if managers have to make decisions to increase the value of the firms through these dimensions, doing so would ultimately increase the value of the firm and for their owners. Okay, in other words, the creditors and the shareholders and other types of stakeholders. Okay, so the last question that I pose here just to motivate this lecture is, how should firms choose projects to invest? They should choose projects based on NPV. In other words, choose the projects in ranking order of maximum NPV, and then you go down the list. So choose projects with obviously positive / maximum NPV. That's how you make financial decisions at the firm. Okay, so today's learning objective, we're going to talk about the NPV rule. In other words, we're just basically saying that the NPV, I'm just going to state the rule outright, which is we're going to choose the project with the highest NPV given all of our alternatives. And then we're going to talk about how to calculate the costs and benefits from the firm's perspective. Namely, we're going to figure out how to determine their so-called free cash flow, or cash that can be claimed by all stakeholders of the firm. Okay, so the NPV rule, which I cover in the next slide, but just to reiterate what free cash flow means. Free cash flow is defined as, so I'll write FCF to indicate free cash flow. FCF is cash that can be claimed by security holders. So creditors, bondholders, stockholders, etc. Okay, so free cash flow occurs every period. So what we're trying to do is figure out for each year, for each month, and so forth, what amount of cash can be claimed by bondholders, security holders, equity holders, whatever. Okay, and because we're working with the net present value methodology, we can actually break down the firm by project, segment by segment, or the whole firm at itself. Okay, so it may be easier to first think about this from the whole firm's perspective, but the idea here is that if you decide to use the NPV rule, it is extremely flexible, and in fact, you can break the firm down to multiple segments and just add everything up, add all the present value up at time 0, and you'll still get the same answer. So in the combination of the NPV rule and the free cash flow, we will ultimately know how a firm calculates NPV, and this can be done project by project, segment by segment. So segment meaning like if a certain firm has certain divisions that are obviously different from the other divisions. For example, conglomerates have multiple segments. You can split the firm into multiple segments and evaluate them separately, and then just add up the cash flows segment by segment, the NPV of those cash flows segment by segment, and get the value of the whole firm. Or you can simply just evaluate the NPV of the whole firm itself. And we're just going to think about this as the whole firm itself for now. All right, so typically for corporate finance people, we usually build a free cash flow model by using what's called a pro forma. So pro forma just means just numbers that's used for the sake of valuations and forecasting. Okay, so that just means that it may be oversimplified a little bit, but for the sake of valuation, that's what people use in the industry. So pro forma literally means for the sake of. Okay, so we take financial results. So these financial results typically is balance sheet information and cash and income statements. And we will use them for valuation and forecasting. Okay, and lastly, we will talk about alternatives to the NPV rule, which typically for professors and financial practitioners, we don't use them unless it's an industry-wide practice. But in any case, I will talk about internal rate of return, or the IRR. And you can think of this as the break-even return. And I'll explain to you how that's related to the NPV formula. And then I'll talk about payback period and profitability index at the end of this lecture. All right. So let's move on to the NPV rule and then our definition of free cash flow for corporations. So the NPV rule is quite simple. When we are making an investment decision from the corporation's perspective, we will take the option with the highest NPV. So what that means is that after we account for the initial cost of a project or the initial down payment of an investment, after accounting for all the future cash flows and taking the net present value, we would choose the net present value that's the highest among all available projects that we can choose from. Okay. And to reiterate what I said before, the NPV rule is, compared to alternatives, is the most robust method to valuation. Of course, you'll realize its robustness in subsequent courses you take at CDU, such as M&A, mergers and acquisitions, or private equity, and so forth. Okay, you'll see that they have different variations and different modifications of the NPV rule, and you'll see that the NPV rule is quite flexible and robust. And most importantly, the NPV rule compared to other investment methodologies is that it is always right, meaning that it's consistent. Whereas the IRR, as I'll explain, you may not always be able to make a decision or the right decision. Okay, so let's talk about the NPV rule. So the NPV rule formula overall looks like the following, which I presented in the previous slides. NPV is equal to the present value of benefits minus costs. But alternatively, you can just also think about this as PV of benefits minus costs, right? And that should give us the same answer, because present value formulas are linearly separable, and if you combine it, you should get the same answer. Okay, so for each period, what should be the benefits minus costs capture? Right, that's the question you should be asking yourself. For each period, what should benefits minus costs capture? So for those of you who have some background in accounting, you may be thinking, oh, maybe benefits minus costs should represent earnings, right? Should it be earnings? So let me remind you how earnings is defined. Earnings is defined as sales minus expenses minus taxes. You can find these numbers, these categories on any balance sheet or income statement. So is this enough? And the answer, obviously, from our perspective, is no. And the reason is because it depends on accounting. A lot of times it depends on accounting methodology. So of course, if you're just evaluating a single firm itself, it doesn't matter. But when you need to compare investments, if you're a portfolio manager and you need to make a decision on investing one firm over the other, their accounting methods may differ. And you may get different numbers, not because of performance reasons, but because of accounting reporting reasons. Specifically, you can think of like LIFO versus FIFO, right? So this depends on accounting method. And example, FIFO and LIFO. So FIFO means first in, first out. LIFO is last in, first out. Okay. And also, earnings depends on depreciation methods, right? And depreciation methods is completely arbitrary. It's an accounting construct, and it's determined by accountants and not by operations. So we need to be able to take out that depreciation component and add it when we talk about taxes, for example. Depreciation is not tax because it's not literally cash, right? It's just some construct invented by accountants. And we need to find some way to add it back in. Okay, so I'll talk about that in the next slide, but for this slide, let me write that depreciation depends on depreciation methods are arbitrary accounting constructs, and it's not determined by operations. Okay, so that's I'm kind of right now motivating that we need a rigorous and robust method to define each period's benefits and costs for the firm, and simply using earnings, which is what accountants typically focus on, is not sufficient. So we need a little bit more rigor and use variables that we can find from balance sheets and income statements to construct something that's reflects cash that can be claimed by any stakeholder of the firm at any point in time. Okay, so let's talk about the definition of free cash flow, or the costs and benefits for the firm for every period, for each period. All right, so free cash flow, again, to emphasize, free cash flow is not only just their cash holdings, but it's literally cash generated that can be claimed by any stakeholder or by all stakeholders. Okay, so this is specific to all security holders. So free cash flow, let me go over the definition first, and then I will break it down piece by piece. So free cash flow is defined as unlevered income multiplied by 1 minus tau c. So 1 minus tau c just means after taxes. So we take the unlevered net income and adjust it for after taxes, add back depreciation minus capital expenditure minus change in net working capital. So I will go over each of these components and a lot of these components in their own separate slides, but let me just give you a general overview of each part first. So revenues, as you know, is just sales times, you know, it's just, you can think of it as just sales. So revenue is just raw sales without any adjustments to costs. Costs can include cost of goods sold and operating expenses, such as salaries. So let me highlight costs here. Costs can include COGS or COGS, which stands for cost of goods sold. You can find this on the income statements of for firms that they report on their annual filings. And they can also include, costs can also include operating expenses, such as salaries. Okay, salaries. Revenue, as I said, is just sales. Depreciation, it's an artificial construct by accountants. It's not taxed, right? It's not taxable because, again, it's a non-cash expense. So we take it out, and then we multiply this sum or difference between three variables by 1 minus tau. So multiplying anything by 1 minus tau will give us the after-tax amount. Tau c is the corporate tax rate. So typically in the US, we assume that tau c is roughly 35% in the US. In Hong Kong, we typically presume that it's around 15%. All right, depreciation, as I said, it's a non-cash expense, so that means that we need to add it back because technically depreciation can be claimed by all security holders. And to reiterate, it is artificial definition by accountants. And finally, CapEx stands for capital expenditures, and delta NWC stands for change in net working capital, or together you can think of it as operational expenses. All right. A term that may be confusing for some of you is the term unlevered. So I'm just going to give you a definition here, and I think it'll be clear what this really means later on. So unlevered means that we don't take into account of debt obligations. That means we don't make any adjustments due to debt obligations. Do not take into account of debt obligations. And you'll see why. I'll explain why later, okay, why we don't do that. Okay, so debt obligations is like interest payments, right? Typically, interest payments is something you should deduct from your cash flow. But the idea here is that a lot of developed nations provide tax incentives for taking on debt, and we would like to have this to we can, rather than reflect it through our cash flow, we can actually incorporate this tax benefit through the discount rate or the interest rate. And we'll talk about that in the next few lectures. But for today, just presume that we're ignoring for now any sort of debt obligations such as interest payments and any sort of tax benefits as a result of taking on leverage. And we'll find a way to incorporate so-called, tax shields or tax benefits some other way, namely through interest rates. Okay. To emphasize, when we think about cash flow, we're not looking at stock variables. We're not looking at levels. Everything here that I showed you here in this formula, they are all so-called flow variables, right? They're just moving from, we're moving something from another place, right? Revenues is money moving from elsewhere into the firm. Costs is expenses that's meted out from the firm to their suppliers and so forth. And also remember that net working capital itself is a level, but we're looking at the change in net working capital. So it is also a flow variable. All right, so let me now talk about each of the components of free cash flow separately to give you a little bit more intuition, more institutional detail, and so forth. All right, as I explained already, one thing that's missing from this free cash flow equation is that we're kind of ignoring interest expenses. But for those of you who are listening so far carefully, free cash flow is at the end of the day defined for cash that can be claimed by all stakeholders. And stakeholders now include creditors and bondholders. So actually, it doesn't affect, the fact that we have interest expenses doesn't affect the economic value of the firm, since creditors are now security holders or owners of the firm. So interest expense looks like it's missing, but it doesn't affect the economic value of the firm. And because creditors or bondholders are now security holders or owners. And as I mentioned already, there is a benefit to taking on leverage in the US and in Hong Kong, for example, because the government deducts taxes on interest expenses. So government deduct taxes on interest expenses. All right, so the question I posed to you in this slide is, should these be included? Why or why not? Of course, they should be included. In fact, interest expenses is actually irrelevant for the free cash flow formula. But tax shield, obviously, it should be. All right. So we should actually be adding back something, right? We should be adding back interest expenses to our cash flow equation because, again, they are part of the amount of money that can be claimed by the owners of the firm. But we're going to take a shortcut rather than include, these tax benefits directly into the free cash flow equation and make this equation a little bit more complicated. We can actually incorporate this tax shield through the discount rate, and I will show you in a few lectures later. Okay, so my answer here will be yes. And we can include them in two ways. First, we can add to the free cash flow equation. That's possible actually if you think about once you get to the more advanced courses such as mergers and acquisitions or leverage buyouts. Adding back these interest payments may make more sense and allows more flexibility, especially since for LBOs, for example, you may have to design a complicated leverage position, and your leverage may change over time, right? In that case, you would prefer to add these interest payments into your each period rather than incorporate this directly into the discount rate. So second is a little bit more rigid, but at the end of the day, it's good enough for standalone corporate company valuation. And we can do this through incorporating it in the discount rate or the interest rate. So we'll talk about that later. All right, so that's the unlevered net income explanation, right? So hopefully everything is clear for now. And of course, I will fill in the gaps as we talk about interest rates in subsequent lectures. All right, net working capital. Net working capital is a little bit confusing for people who have never seen it. So I'm just gonna try to give you intuition first, and then talk about each of these components of the net working capital definition separately. So first of all, instead of looking at the change in net working capital, let's just focus on what net working capital is. Net working capital, okay, intuitively, is the amount of assets that must be in place to keep operations alive at the firm, okay? That means that if you were to liquidate your net working capital, right, you can think of it as cash or a bank account. If you were to liquidate everything in this account, then the firm must shut down. So it's whatever that needs to be in place in order for the firm to continue operations. That's the intuition of what that is. So let me write what I just said. Net working capital is the amount of assets that must be in place to keep operations alive. Otherwise, the firm has to shut down. All right, so net working capital. Let's break it down what this definition looks like. Net working capital is typically defined as cash. You can think of it as cash holdings, literal cash holdings, or securities that's very similar to cash, such as treasury bonds, government bonds, so forth, plus inventory. Inventory is the capacity amount you need for operations, right? Whatever you need to maintain, the amount of goods that you have to maintain in storage so that you can conduct your day-to-day operations. Receivables is the money yet to be received from your customers. So you can think of the first three terms as some sort of assets, right? And lastly, payables. Payables is money that has yet to be received from your customers. So you can actually split net working capital into two parts. The first three terms, you can think of it as working capital assets. And if you can't find these three terms on the balance sheet or the income statement of annual filings, a lot of analysts typically proxy these three terms using current assets. So that's another category that can be easily found on the balance sheet. And the last term, you can think of it as working capital liabilities. And again, if you can't find payables, analysts typically proxy this with current liabilities. And this can also be found on the balance sheet. Okay, so let me expand what these terms mean again. So cash is cash in place used for operations. So you can think of, again, cash, money that you need to buy inputs to produce outputs, right? That's what you need to be, have enough amount of money in your account to keep operations flowing. Inventory is the capacity amount needed for operations. And receivables is money yet to be received. Payables is money yet to be paid. All right. Okay, so the question you should be asking yourself is, okay, given we have this net working capital, what incentives do firms have with regards to NWC? And if you look at the free cash flow formula, you'll notice that we're subtracting delta NWC in the free cash flow formula. So from the owner's perspective, they have every reason to find ways to make delta NWC as low as possible. And the intuition is this. You can think of net working capital as an efficiency measure of the firm, right? A firm can become more efficient if they somehow reduce inventories, for example, or they can withdraw cash out of the NWC so that owners of the firm can claim it as their own, right? Or they can find ways to delay their payables. Either way, all these methods are ways to improve the efficiency of the firm. Okay, so that's why we look at delta NWC, because if the firm changes to become more efficient, then that means that owners of the firm can extract more free cash flow from the firm. So let me write down the examples I gave you to make the firm a little bit more leaner, more efficient. So firstly, a firm can find ways to delay payment of liabilities. So you can do this by increasing payables. Alternatively, you can take out cash. For example, if you find a different vendor that charges less for inputs, you can take out cash, right? If you can produce the same amount of goods for less. Third, you can reduce inventory. Right? So these are three ways, and if you look at these three ways in a overall big picture perspective, all these three examples are essentially withdrawing money from an account, right? It looks like it's just withdrawing stuff. Withdrawing value from an account. All right, so to emphasize, net working capital, you should think of it as a way to measure how efficient a firm is. And if a firm becomes more efficient, they can withdraw more resources, more value from that account, and then those value can now be claimed by the owners of the firm. Okay, and it's important to know that we can't liquidate net working capital, because if we return the net working capital to the shareholders or the creditors, the firm must shut down. That's the definition of net working capital. So we can't return to owners, otherwise we must shut down operations. Okay, so hopefully that explanation was clear what net working capital is. The last component I didn't really go into because I think it's quite obvious what that is, which is CapEx. CapEx just means capital expenditures, so that's just money that you spend to buy assets, such as computers, real estate, whatever you need to make investments to generate returns for the firm. So that's just another sort of expense. All right, so to summarize, how to calculate NPV for a particular project or segment or firm, what you need to do is you need to make projections about sales, revenue. You need to project the costs of goods sold. You need to project SG&A, which is, you can think of it as, salaries and so forth. So there's just a bunch of expenses, and you need to forecast depreciation. And so let me give you precisely what SG&A stands for. SG&A is selling, general, and admin expenses. So this SG&A should include salaries of employees. Again, I already mentioned what COGS is. It's cost of goods sold. Depreciation, again, it's an accounting construct, but once you make the projections of all these variables, you can then be able to calculate free cash flow, right? So to summarize, free cash flow is defined as calculating the earnings before interest and taxes, or EBIT, adjusting it for taxes to get the unlevered net income. And then once we project net working capital and calculate change in net working capital, we can finally calculate free cash flow. So remember, free cash flow is a flow variable that occurs every period. And once we have a proper discount rate, we can discount each of those flows back to time zero to get the net present value. So we'll talk about the discount or interest rate later on. All right, let's move on to the next topic of this week's lecture, which is on interest rate return, a rate of return, or IRR. So IRR, again, you'll see parallels between what I present today and what I'll present next week on bond valuation. In a nutshell, IRR is simply looking at the break-even rate of return from initial investment and the subsequent future cash flows in the future, right? It's calculating a percentage return. All right, so let me give you a definition here. So IRR is the interest rate that sets the NPV of a project to zero. So as I mentioned, it's a break-even return. And your goal here is to solve for the interest rate that gives you this break-even return. So if you look on the left-hand side, so there's a typo here, so don't look at this equal sign. So the left-hand side is the sum of all cash flow, right, from today all the way into the future. And we want to set all that cash flow equal to zero. And we want to solve for y. So recall, this only really makes sense if, C0 is negative, right? And C1 ... to CT is positive, right? Or C1 C.CT is positive. All right, so if you think of it that way, that just means that we want to solve for the return that makes our initial investment return we find the return such that it makes our initial investment break even with the future cash flows. So CT is typically given to us, and our task therefore is to solve for y. And this is you can think of it as the average return, or the break-even return. So what does this look like in a timeline? So let me give you what that looks like in a timeline. In a IRR framework, we typically have an initial cost or investment. So that's, let me give you, let's say we're doing annual periodic cash flows. So 0 stands for today, 1 stands for 1 year from today, 2 stands for 2 years from today, and so forth. Okay, and if we have an initial investment of $100, so you have an outflow of cash today, but suppose that this project pays $50 every period up to time big T, up to year big T. And your goal is therefore to solve for the discount rate that makes this net present value equal to 0. That's the task at hand. And so how does this differ from the NPV rule? So recall what the NPV rule is for every available project you have at your disposal, you're supposed to calculate the net present value and choose the project with the highest NPV. But the IRR rule is going to be different. you actually need to be given an opportunity cost of capital or hurdle rate and compare that hurdle rate to the IRR in order to make that decision. Okay, so what I state here is that you should take any investment opportunity where the IRR exceeds the opportunity cost of capital, and this is the hurdle rate. This has to be modeled or calculated or given to you by your boss, for example. So I know, for example, for venture capital firms, they typically have an internal hurdle rate, and you have to only choose. You can only choose projects in which the IRR exceeds that internal hurdle rate. Okay. If your IRR does not exceed that hurdle rate, then you would just ignore that option. Okay, so let me emphasize what the decision-making rule is. You basically choose the project if the IRR exceeds the opportunity cost of capital. And this MPV rule will give you the same decision, okay? But the other direction is not necessarily true, okay? And I will show you that in several examples. So to reiterate, if the MPV is positive, then that implies the IRR will exceed some hurdle rate, okay? And you will make the same decision as you would if you used IRR or MPV. However, if your IRR exceeds the hurdle rate, it does not necessarily mean that the MPV is it does not necessarily mean the MPV is the max, the highest, okay? So give you more intuition what the hurdle rate is. It's the returns of the next best alternative investment. So that's RC. All right, so let me give you an example of simple IRR calculation, and I'll actually plot the IRR next to MPV to show you what that looks like visually. So take, for example, this simple IRR calculation. In this table, we have 3 periods, 3 years out, and we have an initial investment of $5,000. So remember, when we make an investment, that's an expense, so that's a negative sign. So this is initial investment. And C1, C2, and C3 are 3 years out, and in each year you will have an inflow of cash of $2,000. Okay, so how do we calculate the IRR? It's quite simple. We just set up the MPV and set it equal to 0. Right, so the MPV looks like the following: negative 5,000 plus 2,000 divided by 1 plus y plus 2,000 divided by 1 plus y squared plus 2,000 divided by 1 plus y cubed equal to 0, and we solve for y. So the algebra is probably very complicated, so don't worry about the exams in this class. I'll give you calculators or allow you to use Excel, whatever. So don't worry about that. And in fact, I did this calculation in Excel. So the IRR in this question is around 9.7%, and you can simply use the IRR function in Excel, and I used an initial guess of 0.09. Okay, so the ... just means the cash flow, the sequence of cash flow, and once you plug that in, the IRR function will spit out 9.7%. Okay, so how does this relate to the MPV rule? So let me write that down above here. The MPV rule simply states that we should invest when MPV is greater than 0. Okay, so this is the case in which we have just one project available, and we are deciding whether or not to invest or not. Okay. Conversely, the IRR rule states that we should invest when the IRR is greater than the hurdle rate. And we should actually conclude the same answer in this case. So let me show you what this looks like graphically. So on the y-axis, I'm going to plot MPV as a function of the discount rate. So we're going to vary the IRR essentially until our MPV is 0. And if you plot the MPV equation, which is defined as negative 5,000 plus 2,000 divided by 1 plus R and so forth. So I already wrote this before, but I'm writing it again just for clarity. All right, you'll see as we solved already, this intercept term here, or root, right, is going to be 9.7% as we solved already. And in fact, there's a linear relationship between MPV and interest rates, or discount rate. Okay, so any point above the line is going to be positive MPV. Anything below the line is going to be negative MPV. So R in this case, again, is opportunity cost of capital. All right, so given this example, can we actually figure out if we should take on this project? So as you should realize, there is a missing piece. The missing piece is the fact that we don't know what RC is. So we can't actually say anything in this example. We know that the IRR is 9.7%, but if our next best alternative has a return of 10%, then we should not take this project. We should put it in the bank and earn 10% or whatever. Conversely, if our next best alternative return is lower than that, then obviously we should take on this project. So to reiterate, we do not have enough info to decide if we should take the project. We do not know the cost of capital. All right. To summarize our conclusions about IRR and MPV, is there a difference between IRR rule and the MPV rule from the preceding example? Of course. In the example, there is no difference so far, but I'll give you several examples in which we will be unable to draw any reasonable conclusions. In fact, we may be drawing the incorrect conclusion if we decide to use IRR. So to remind you, MPV is always right, but IRR, it will depend, and I will show you some examples. Is there any reason to use IRR? As I mentioned before, IRR is useful as a marketing tool, basically. But I know for a fact that it is used in the VC PE industry. Again, most likely because it's a good marketing tool or just good rule of thumb internally to decide projects. All right, so let's talk about examples in which the IRR doesn't make any sense. Okay, suppose we have two projects with the following free cash flows. For project A, you'll see that it is a investment. It is a lending. It is an investment project. So that means that at time 0, we have to allocate $5,000 somewhere, and then we generate 2 periods of free cash flow of $3,000 in 1 year out and 2 years out. Okay. In the second project, project B, you see that the signs reverse. So we observe a positive inflow of cash at time 0, but then we have two subsequent periods of negative $3,000 in year 1 year out and 2 year out. So it may look confusing at first, but you should think of project A as lending money and then gaining some returns in the future. Conversely, for project B, you should think of it as borrowing money today and then returning that money in the future. Both have different returns, obviously, and that's our task here. Let us first calculate the IRR for these projects. So now we are given a opportunity cost of capital, which is 10%, and so actually now we should be able to make some conclusions. Okay, so let's calculate the extra return from project A and project B compared to the opportunity cost of capital. So rather than solve this by hand, I solve the IRR for both the project A and project B using the IRR function in Excel. So go ahead and just use what I use. So the ... is the sequence of cash flows, and the guess is 0.09 or 9%. Okay, so this is what I get. Project A extra return. So extra just means the difference between the IRR and the cost of capital. That is defined as 13.07%. That's my IRR that I got, minus 10%, which is the opportunity cost of capital, and I get 3.07%. Okay. Again, the idea here is that my next best alternative is 10%, and I'm investing in a project with 13.07%, and therefore my extra return is 3.07%. For project B, I am borrowing at 13.07%, so that's presuming that I'm investing in the next best alternative, which apparently is the opportunity cost of capital, right? So that's going to be 10%, right? Because I'm borrowing money to invest in the next best alternative, which is 10%, minus 13.07%. If you did project B, you'll figure out that the IRR is also 13.7%, and that's going to give me negative 3.07%. Okay, so you should, based on this example, you should take on project A, right? All right, so it may seem very similar to MPV, but I'm going to give you an example where things don't work out the way they're supposed to be. Okay, so first things first, let's move on to an example in which there are multiple solutions to the IRR. All right, so suppose you have two mutually exclusive projects, so that just means that you can only choose one or the other. And I'm going to show you that the IRR for B doesn't exist, and the IRR for A is non-unique. Okay, so for project A, I use the following functions in Excel. So you can try IRR ... 0.09, and you can try IRR ... and 0.2, and you will get two solutions. In fact, if you plot the MPV with respect to the IRR, you will get two roots. Okay, so you have two solutions. Which one should you choose? There's no clear way to determine that. Okay, for B, you can try any number using the IRR function, and you won't get anything. You won't find a solution. So you can try any guess. Okay. In fact, if you plot the MPV for project B with respect to the IRR, you'll see that the MPV actually never crosses the x-axis. So the root doesn't exist. So what you should note is, this is of course a mathematical derivation. You should note that when you typically have alternating signs, positive, positive, negative, positive, or negative, positive, negative, that usually means there's going to be a non-unique IRR or no solution. Okay. All right. So under this example, we can't even make a decision, right? Because the roots, there's no way to choose which IRR is the correct one, and also for B, there is no IRR. All right. So IRR fails. But if we still rely on the NPV method, we can actually still make a conclusion. All right, so let me give you an example in which you will most likely make an incorrect conclusion based on IRR. And the reason is because the initial investment is actually different for these two projects. So in this case, look at project A and look at project B. Ignore the cash flows 1 year out and 2 year out. If you focus just on the initial investment, you'll notice that project A has a lower investment requirement than project B. And just simply based on these two differences, which project you decide to take on depends on what your opportunity cost of capital is. And I'll show you that visually after I calculate the IRRs. Okay, so if you use Excel and you calculate the IRR for project A, you will get 31.87%, I believe. And if you do the IRR for project B, you will get 24.46%. All right, and I'm going to show you that graphically what these two curves looks like when I plot the NPV with respect to the IRR, or the opportunity cost of capital. So let me draw this actually to the left. So if we have a graph here where the y-axis is NPV and then our discount rate is the x-axis, if we plot project B, it will look like this downward sloping curve, but A is actually less steep. Sorry, it should look something like this. Yes. Okay. And you'll see that if our opportunity cost of capital is 15%, you will actually choose project B. But when the opportunity cost of capital is 20%, you will actually choose project A. So A and B. All right, so at the end of the day, we can't make a decision because it really depends on what our opportunity cost of capital. And we can't decide actually which project dominates the other one, right? So in other words, IRR can be misleading. And the reasons comes from the fact that the investment size are different. So IRR can be misleading. These projects have different sizes. The IRR rule does not say choose project with highest IRR, right? So purely based on IRR, we can't actually make any sort of conclusions between A and B. But if we look at the NPV rule, it's clear, right, which one we should choose, conditional on what the IRR is. Sorry, what the opportunity cost of capital is. All right, so that's our discussion about IRR. Hopefully you are convinced that IRR You should know how to calculate it because it's important when it comes to bond valuations. But for making decisions, it is not a reliable tool, particularly for investments of different sizes, and also if you have cash flows that alternate signs over subsequent years. In those cases, you may have IRR with several roots, which is not good, right? Because there's no way to choose there's no rule to choose the right one, and also you may have NPV or that doesn't have any roots at all. In that case, the IRR doesn't exist. All right, so for the last part of this class, I will talk about two other ways to make decisions, two other metrics to evaluate financial projects or projects, and to projects that would improve the financial performance or financial value of the firm. The one I want to talk about next is called the Profitability Index. So the Profitability Index is not really different from NPV. It's simply scaling the NPV by the initial investment. So in other words, we're kind of just taking out the investment at time 0, and we're just putting it into the denominator rather than leaving it in the numerator. Okay. So to be precise, let me give you the definition of Profitability Index first. It's equal to the value created from the project. So that's the future cash flows after time 0, and resource consumed is now placed in the denominator. So this is just another way of looking at NPV, but rather than keeping the initial investments, the minus amount at time 0, we're simply moving it to the denominator and leaving it positive. You should actually draw the same conclusions when doing this. Okay, so NPV here actually refers to just purely future cash flow, right? After time 0, and then the denominator, resource consumed, is the cost today. So that's your initial investment. So the denominator can be anything, right? You can look at it as CapEx or other scarce resources such as within the firm, such as human capital, salaries, whatever. But the profitability index rule should actually force you to give you the same answer. So is there a difference between the NPV rule and the profitability index rule? No. It gives you the same answer. All right, so the idea here is that for the profitability index, if your PI or profitability index is greater than 1, then you should make the investment. If it's equal to 1, you're breaking even. If it's less than 1, then it's not a good investment. Okay, so the last topic is called a payback period. So payback period just means it's basically asking what is the earliest time you can recover your investment. So we're not looking at value creation. We're actually looking at the speed of recovery of your initial investment. So if you want to write this down mathematically, we can. So let me write down the formula first and then explain the components. All right, so argmin just means that we're minimizing this expression here, but we're trying to find the value n, okay, that allows us to find the lowest possible value for this expression. So this expression simply states that the sum of the cash minus the initial investment. So C naught is initial investment. Okay, so minimizing n, as you can imagine, if you allow a project to continue for a very long period of time, N can be large, but we're trying to find the N such that we recover our initial investment as soon as possible. So let me give you an example. Suppose we have a timeline here where at time 0, we have an initial investment of $100. In 1 year, we have $50, 2 years, $50, so forth. But the earliest time we can actually recover is going to be at 2, right? So our N star, or the N that minimizes the difference, is going to be 2, right? So N equals 2. All right, so this may seem intuitive, right? If you're extremely risk averse, you want to know how fast you recover your initial investment. And that may seem reasonable to you for most people in terms of evaluating whether or not to pursue a particular project. But the problem with the payback period method is that, of course, you are ignoring the time value of money, right? This is something we talked about in the first lecture. The time value of money means that we have to take account of what your opportunity cost of investment in each period, okay? So in other words, if you use this method, we are ignoring long-term amount of money, right? It's possible that the cash flows may increase over time, right? That is important, and that can actually contribute to the overall present value of a particular project. And we are also ignoring the time value of money, right? And this is basically saying we are not accounting for risk. Right? There is no way to factor in risk based on this methodology. And as stated earlier in this lecture, we have to have some form of interest rates to capture this risk. All right, so let us conclude this lecture by briefly summarizing what we went over today. So today we talked about the rules of capital budgeting, or just applying the time value of money and the present value methodology to decision by looking at accounting variables from the corporation's perspective. The NPV is the present value of benefits minus the present value of costs, and we can represent benefits minus costs through the free cash flow definition for corporations. The NPV rule tells us that we should choose projects with the highest NPV, and therefore using the NPV rule we can actually compare projects between each other. The reason is because NPV rule correctly accounts for the time value of money through discount rates, which we will get to in subsequent lectures. And compared to other ones, NPV is always correct. Okay. The other methods, such as internal rate of return, it only works if investment size is the same, and in that case we can compare products between each other. Otherwise, IRR is not comparable between projects. It will be conditional on what your opportunity cost of capital is. In that case, and under those circumstances, you might as well rely on NPV as opposed to IRR. Okay, payback period is something that's intuitive. A lot of people use it as a rule of thumb on how quickly you can recover your investment. But the problem, again, is that it ignores the long-run possibility of projects generating superior returns, but it's also ignoring risk, right? And risk is accounted through interest rates, and we're not doing interest rates aren't even part of the objective equation for the payback period method. And lastly, we talked about a profitability index. So profitability index is just a modified version of NPV rule, but it should give you the same result as decision-making rule as the NPV method. Okay, so over the next subsequent lectures, we will talk about interest rates and how interest rates can ultimately account for risk and how that's going to play out in our NPV model. Okay, so that's the end of today's lecture. If you have any questions, please leave a comment or send me an email. That's it for today, and have a nice day.